It's Friday, September 23rd, 2022, episode 196. I'm Kevin Muir. This week we have an interview-only show, but don't worry, we have a terrific guest. John Roque from 22V Research joins us to discuss why he thinks the top is in for the stock market, what surprises he sees in store for bonds, and why market participants might not be ready for the new reality. Two other housekeeping items. Please be aware that we recorded the interview Monday night. And then finally, we won't have a show next week, September 30th, and we'll return on October 7th. All right, then, let's roll the interview with John. It's our pleasure to welcome to the show John Roque from 22V. He is the head of technical strategy, but he tells me that that's a highfalutin title because he's the only fellow there. John, thanks for joining us today.
Thanks for having me, Kevin. It's a pleasure to be here, and you got that right. I'm the only guy doing it, so I guess I'm really important.
When you were chatting earlier, you were mentioning that you have a strong New York accent, and as we kind of got to know each other a little bit, I realized that is correct. I can't wait to hear your story about how you got into this business, because I looked through your resume, and it's just, wow, the different shops that you've been in and the different experiences you've had over the years is fascinating. But before we get to that, why don't you tell us a little bit about where you grew up, what school you went to, how you kind of got interested in Wall Street?
Okay, so I'm a Westchester County guy from Mount Vernon, New York. And I went to Mount Vernon High School and then Fordham University. And I took a long time to disabuse myself of the notion that I was going to be able to play baseball for a long time. It took me a long time to figure that out. And then when I graduated, I played baseball for 2 years at Fordham, but after that, I left Fordham and then went for an MBA degree at Fordham as well. And while getting my MBA degree, I started working on Wall Street in a back office position for what was the old Union Data Service Center, which was owned by J&W Seligman.
Okay, so I'm going to interrupt here because I have so many questions. First of all, what position did you play?
Oh, I was an infielder.
You're an infielder. And you played for the college team? Did you ever get scouted? Was there
No. This is I should have had a more important career, but I did not. Or at least in my mind, I think I should have. So it was a very modest 2 years on the Fordham baseball team. Although baseball is still my favorite, I love it, and I wish I had done greater things. But as my uncle once said to me, "Don't worry about it. You're in the major leagues now." So I thought that was a pretty good line.
That is a good line. So when I was researching you, I came across Fordham University, and I'm a Canadian, and I know a lot of universities in the States, but I didn't know this one. Can you tell me a little bit about it, and just because it's actually a fascinating story?
So Fordham has a campus in the Bronx. It's known as Rose Hill. It is across the street from the Botanical Garden, and on the other side of the campus, it is across the street from the famed Arthur Avenue, Little Italy of the Bronx, and then not far from the Bronx Zoo. So Fordham is centrally located just off the Bronx River Parkway and off of Pelham Parkway and Southern Boulevard. And I commuted. I didn't live at school. I commuted. I thought it was a great time. I thought Fordham was a wonderful school, and I think I got a pretty decent education. I don't think I could get into Fordham now because I think the standards are much higher.
Now, you have some famous alumni, which actually includes a president.
Well, there's some great alumni from Fordham University, and especially for folks who want to stay in the New York City area and work, the alumni base is pretty darn strong. So I think that's something to be proud of. And Fordham, I think, and I'm being serious now, I think Fordham's reputation is pretty good. And I've met quite a lot of people in our business who've gone there, and I'm glad to have gone there. I'm glad to call myself a Ram and be an alum. And I occasionally get back to the campus and enjoy sporting events there, football and or baseball and basketball. So I think it's a great campus. If people didn't know and they were blindfolded and then they were dropped into the middle of Fordham's campus, they might think that they're in Connecticut or some other bucolic setting, because the campus is quite nice, despite the fact that it's some people might not think so because it has a Bronx address.
Right, and I think it's the largest privately owned green space in New York, apart from like the Central Park. One of the things you didn't pick up on is that President Trump is an alumni.
Oh well, so I think he graduated from University of Pennsylvania.
Yeah, but
He went there and transferred out.
right. And then we
Right.
had, so I was researching, you got Denzel Washington, Alan Alda, but the real important one is you have Bob Keeshan, which is Captain Kangaroo.
Captain Kangaroo. Yeah. So Denzel Washington also went to my high school.
Oh.
He's a Mount Vernon guy from way back. So there's a nice connection there for being both from Mount Vernon and then both going
wow.
to Fordham.
Well, let's see if we can make you more famous than Denzel Washington.
Oh gosh, I hope not infamous.
All right, so you're there, you graduate, you get you're working in the back office on Wall Street. Why don't you walk us through after you graduate from the back office? What's your kind of first more sophisticated job?
So when I was at Fordham, Fordham had some career nights, and I went to all the career nights, and I realized something that kind of put a chip on my shoulder. And what I realized was that the companies coming to Fordham to recruit at that time were not recruiting for the training programs at some of the big banks, big investment banks. And so I had a chip on my shoulder because I thought that, my goodness, I should at least get an opportunity, or people from Fordham should at least get an opportunity.
Right.
And that wasn't afforded to me, or maybe some others at Fordham. And so I did what anybody in my position would do at that time, which was 1990. I started to look in the New York Times in the want ads on a Sunday. And that's how most people at that time looked for jobs. There was no, online service for this. So you had to look in the New York Times. And I found a place in White Plains, New York that was called Safian Investment Research. And there was a want ad there. And I sent in my resume, which was very small at the time, and I sent in my thesis paper, which I actually got an A on. And I went there, had a few interviews, and I was hired by Ken Safian. And so I would like to say, very in a complimentary fashion, that Ken Safian kind of started me on my way in this business, because he allowed me to do a lot, and he taught me a lot without necessarily teaching me directly, but allowing me to just be a part of, let's say, conversations with his clients, or the working through putting together research reports for clients. So I want to say thanks to Ken for helping me along in that regard.
All right, so you're there, and why don't you tell us? I'm not familiar with that firm. What was it? And
yeah, sure, I'll tell you. So Ken Safian ran Safian Investment Research, and in the late '60s, early '70s, Ken Safian had a partner named Ken Smilin, and these two guys ran what was at the time one of the top research boutiques on the street. And they came up with a very interesting concept at the time, which was known as the dual market principle. And based on the economic cycle, their analysis would help you determine where we were in the economic cycle and which sectors you wanted to be overweight, either growth or cyclical. And that was their kind of, I would say, their raison d'etre, or that was their calling card. And then the two partners split up, but Ken Safian continued the work in that regard. And, he published his thesis or his findings for a long time. And I'd like to say that I took Ken's idea and I appropriated it for my own use at this cycle. And I call it growth to non-growth. I don't call it growth to cyclical. I call it growth to non-growth. And so I publish often a growth to non-growth ratio. And it's my take, and I'll just, jump forward a lot, that I think the growth stocks that made most of the people in this business a great deal of money over the past 20 years, I think that cycle's ended. And I think that non-growth is going to outperform growth. And I actually think that there might be some kind of middle ground if we had kind of a Venn diagram, and growth was the left circle and non-growth was the right circle. And the overlapping part would be somewhere of course, in the middle. And that's where I think we're going to have to be associated with going forward with respect to picking stocks. It won't necessarily be non-growth, and it certainly won't necessarily be growth, but it'll be something in the middle. And something in the middle is, I think, utility stocks.
Okay. And so just tell me a little bit more about the original model and then how you changed it.
So the original model was really just growth or cyclical. There was nothing in between. And Ken Safian and I'm going to put words in his mouth because I think that I learned my lesson. When economic growth was scarce, you wanted to be in growth stocks. And when economic growth was accelerating, you wanted to be in cyclical stocks because those stocks had the leverage, so to speak. And that was their time to shine because the economy was expanding. And I changed it a little bit because most people now consider it growth to value.
Okay.
And I didn't want to define value because I'm a technical analyst, and I thought that there were a whole host of fundamental people out there and strategy people who could define value better than I could. So I called it non-growth because I thought non-growth would be easy to identify.
Okay.
And so that's how I came to the growth non-growth ratio, and it peaked. Its momentum peaked in the spring of 2020. And of course, as you well know, because we've had a difficult year in 2022, the momentum really has, for lack of a better phrase, crashed during this whole period. That's not to say the market has crashed. It's just to say the momentum has, because the momentum was so spectacular on the way up that when it peaked and rolled, it rolled in an equally spectacular fashion on the way down.
Okay.
And so.
Well, let's save some of this because we're gonna have a long discussion. You got some charts and we'll do stuff like that. So let me just learn. Then you're there, and from there you go to Lehman Brothers.
Right.
Are you getting hired as a technical analyst at that point?
Yes. So I left Ken Saffian and I applied at Lehman Brothers to work for a gentleman by the name of Steve Shobin. Steve Shobin worked for Bob Farrell for 26 years at Merrill Lynch, and Bob Farrell was the dean of technical analysts. And then Steve came to work at Lehman Brothers, and he needed someone on his team. And I interviewed with him, and I interviewed with the research people at Lehman, and I was hired to work for Steve. And while Ken Saffian was very kind to me, Steve Shobin was equally as kind to me. I asked him 1 million questions over 4 years. I'm not kidding. Perhaps more than 1 million questions. And he kindly and gently and patiently answered all of them for me. And Steve was doing the U.S. markets at the time, and he said, I'm bringing you on because I want someone to do the international markets. So at the time, and I say this with no self-aggrandizement, I may have been one of the only guys, if not the only guy, on the street doing technicals on international markets. So I built a whole host of indicators for European markets, Asian markets, Japanese market, Latin American markets. And Lehman Brothers afforded me the opportunity to kind of write research and publish research on technicals for international markets and international stocks. And luckily for me, international at Lehman was a big business. And so I had a whole host of salespeople there who were very kind to kind of market my work. So that was a great period for me.
And not only was it a great period in terms of Lehman giving you the freedom to run with it, you also, that coincided with the Asian crisis. That must have been just a fascinating seat to be in during that period.
It was a tremendously fascinating time. Well, I left Lehman Brothers in 1998, kind of just as that was, coming to fruition. So it was a tremendously fascinating time, and there was certainly a lot of risk at that time. I remember the Hong Kong Monetary Authority told people that you can't short stocks anymore, and that kind of was the bottom. But I think that set the stage for what was the big kind of five mafia family rally that took the S&P and NASDAQ into its peak into the year 2000. That was kind of, tech, telecom, media, biotech, and I may be missing one of them right here, but that kind of set the stage for that great big, blow off top for tech in the early part of the year 2000.
Which was just, I know we experienced a ferocious rally in the last couple of years off the COVID lows. But when you go and look at the charts following long-term capital and looking at what NASDAQ did from that period from 98, that I guess the fall of 98 all the way to the March of 2000, it was mind-blowing.
It was mind-blowing. And, just to give you an idea, so NASDAQ was roughly at, let's call it 600 at late 1994. And then it peaked at over 5,000 in March of 2000. So, in a span of less than 6 years, it went from 600 to 5,000. That's tremendous growth. But I'll tell you, the move for NASDAQ from what was, let's call it 4,000 in 2014 to over 16,000 in 2021 was also kind of a 6 to 7 year period. That was also quite explosive, and the growth to non-growth ratio that I just mentioned uh, into the peak had some of its biggest returns, and so I thought that we had kind of had a second coming of the peak in the year 2000 as it occurred into 2020 for its momentum, and then 2021 for price.
Right. Okay. From there, you leave Lehman and you go to this firm, and I'm extremely interested in it. When I was learning about it, first of all, how do I say this firm? Arnold S.
Arnhold and S. Bleichroder.
Okay.
Arnhold and S. Bleichroder went back to Kaiser Wilhelm days in Germany, and the Bleichroders were the bankers to Bismarck.
That's right. And so the part of this story that I love is that as I was growing up, my mom was a history major, and we had a Rottweiler, which is a German dog, and she named it Bismarck, and
Wonderful.
and everyone made fun of her for this, very staid kind of historic name. And then she decided that she had enough of it, and she named the next one Thumper. But so I actually know about Bismarck a little bit because of our dog that we were growing up. But I was fascinated to find out that this firm had been around this long. I guess it's one of the oldest, banks / money management firms.
Yeah, I think it was originally an investment bank, out of Germany, and then the Arnholds came to the States, and Henry Arnhold actually worked for the Office of Secret Services during World War II, and then started his firm here.
Yeah.
And I worked for his son, whose name is John Arnhold, with whom I'm still in contact with, who's among the nicer gentlemen, among the better guys on the street. He was also very kind to me and gave me a lot of freedom when I worked for him at Arnhold and S. Bleichroder. And I thought Arnhold and S. Bleichroder was just a wonderful, wonderful place to work. A small firm relative to Lehman Brothers, of course, but provided me a great platform and great freedom to kind of be authentic and imaginative with my research, as much as we can do in a kind of a sometimes boring business. And I just thought it was a great period there. And I worked there for 11 years. It was really a wonderful period.
And then the next one is a name that everybody's going to know. You went to work on the buy side, and you went to work for a very, very famous hedge fund. Tell us about that, and tell me what the transition like from the sell side to the buy side was like.
That's a good question. So I went to work at Soros Fund Management on Valentine's Day in 2012, and I had some contact with them over the years because I would provide research to them and then go and visit them on occasion, and I thought I understood how Soros Fund Management worked. And when I got there, I realized that I didn't know anything about understanding anything about Soros Fund Management. I would also like to say that I don't know Mr. Soros, George Soros, at all, but I may use some of his sayings because they've helped me along the way. But I had a wonderful experience there. I thought, if I could use a sports analogy, that working at Soros Fund Management was sort of like being asked to play basketball for Dean Smith at the University of North Carolina.
Okay, that's a good analogy.
I certainly wasn't in the starting lineup at Soros Fund Management, but I thought that even being a part of the team, much like being a part of the team at the University of North Carolina as a Tar Heel playing for Dean Smith, was a great experience. I learned a lot. I met a lot of good people in the business, and I did a good job trying to listen because I thought that was the best way to kind of understand or try to understand what was going on there, what they were trying to do, and how I could ultimately pitch in a little bit.
What was your biggest surprise going there and like being on the buy side?
Number one was that people wanted to talk to me from the sell side. I'd spent a long time talking to people when I was on the sell side and they were on the buy side, and now I was on the buy side, and I didn't know how to embrace or accept the fact that I was now being solicited, but not in a bad way. But people were calling me, to try to sell me their services or get me on their research list, and I thought that was very odd. I just didn't know how to take it. And then the second thing I learned very quickly was that though you're on the buy side, you should really approach your position as if you were on the sell side, which meant to me that I needed to be active, I needed to be commercial and go and see the PMs who actually were taking risk. write research for buy side consumption,
Right.
and to be honest about my failings. If I got something wrong, I should say I got it wrong. There's no getting around it. Just say you got it wrong, you made a mistake, and you'll do your best to get it back, so to speak. But I thought that you had to have kind of a sell side approach while being on the buy side, because I think otherwise you can fall into a trap of just expecting people to reach out to you. But I needed to understand that their jobs kept them so busy that I needed to reach out to them.
Oh, that's a fascinating insight. All right. So then eventually, though, you go back to your current place, which is 22V, which is the sell side. Tell me a little bit about your shop and what you guys are, trying to accomplish and what your firm is about.
Okay, so 22V Research was started by four gentlemen who had worked for a long time at the famed ISI, which is run by Ed Hyman. And 22V, 22 comes from one of the founders' fathers. So Dennis DeBuscher is one of the founding partners here. His father was Dave DeBuscher, who was a Hall of Fame basketball player for the New York Knicks. In an odd kind of sports trivia vein, Dave DeBuscher, Dennis's father, was also a pitcher in Major League Baseball. But he made it to the Hall of Fame by being a power forward for the New York Knicks. A great defender, a great rebounder, and you can see his exploits certainly at the Naismith Hall of Fame in Massachusetts. So that's where the 22 comes from. That was his number for the Knicks. And so Dennis and three other partners start 22V with the idea that we can be a macro research boutique. And Dennis and his other partners, Vinayak Singh, Colin Crowley, and Brian Herlihy, certainly had great experience while working for Ed Hyman at what was, for many years on the street, the preeminent macro research shop. And so we're trying to do some of the same things here. Dennis and his partner Brian run the quant and / strategy product. We have a gentleman by the name of Kim Wallace, whom I worked with at Lehman Brothers all those years ago, who runs our Washington policy group. There's a gentleman by the name of Gerard McDonnell, who worked for a long time at SAC Capital as an economist, and he does our economic work. And then I do the technical work, and we've just hired a gentleman by the name of Michael Herson, who is going to do our China policy and China research. So I think we have a very exciting offering or lineup, and I've been here for almost a year. My anniversary will be in October. I'm glad to be here. It's an exciting place, and everybody's in. And that makes it even more exciting because we get to see our teammates and colleagues on a daily basis.
That's awesome. Okay, so now let's jump into the markets. We're going to pick that brain and all the years and decades of wisdom in there. And I'm going to start with a quote that I grabbed from one of your recent pieces, and I'll read it to you, and then we'll go from there. Yet, despite these concerning inputs, it remains more than curious to us that many equity investors are reluctant to use phraseology bear market. The phraseology bear market. Make no mistake, bond investors correctly term what they're experiencing as Bondmageddon. But equity investors still believe in their heart of hearts that the Fed will not do too much damage to equities. In short, these same equity investors believe that the Fed will, before too long, arrive just like Mighty Mouse to sing, "Here I come to save the day." Equity investors generally think everything is already discounted. As you know, we believe they're wrong. I'd love to hear why you think that they're wrong and maybe explain where you're coming from with that quote.
Okay. So I'll tell you a little background. So when I got to 22V Research last October, in November, I said in one of the research morning meetings, I said, I think we've made the highs for this cycle. And though I'd known the four, or at least three of the founding partners for some time, all of them looked at me like I had an eye in the middle of my forehead. They thought I was a little bit daft. And so the reason I wrote that is because I really do think that we've made the highs for this cycle. And I believe firmly that the Fed has, for the most part, boxed themselves into a corner. And so most equity investors, I think, at this stage of the game have grown up in the almost never failing buy the dip mentality, because the Fed always has come to the rescue to kind of, as Mighty Mouse did, save the day. But I think because the Fed has boxed themselves into a corner, and they've explicitly told us they're going to continue to raise rates to break the back of inflation, and they have told us they're going to embark on QT, quantitative tightening. So they're kind of doing the opposite of what they did for what was 20 years. And so not only have they decided to do the opposite, but they've almost kind of, put the car in reverse, which is, again, the opposite, and slammed on the brakes at the same time. So I really think that equity investors have been ill prepared for the difficult period. And we've gone through kind of 9 months now of difficult period. I think they're ill prepared for it because they've always been able to buy the dip, and they had been right for a long time about that. But I think the cycle has turned. So that's why I wrote that bond investors are much more sober about what they've experienced, and what they have experienced. And I think that they realize more than equity investors that this difficult period is likely to continue. But I think equity investors always believe that you can buy the dip, stocks are cheap, everything is well discounted, everything's well known. And I just don't think that's the case. I think people kind of got a little bit, there's been a great illusion for many years, although it was right for many years, but I don't think that that's still the case. I think the cycle has turned.
One of the things that I notice is that when you look at a lot of the sentiment surveys, you'll see that the sentiment is really bad. But at the same time, there's been some pushback to that, arguing that although sentiment's bad, it's you have to watch what they do, not what they say. I'm wondering where you stand on that, whether you think that the positioning is as short as it appears in those surveys.
Okay, so I'm glad you asked that question. I actually went through this, and made my own file, so to speak, about short interest, because I've heard, much like you've heard, that hedge funds are short, or investors are short. They're not long anymore. And so I went through it, and I found that is not the case. I looked at 30 big cap stocks, and they're the 30 biggest cap stocks. And the average short interest as a percent of the float was about 90 basis points.
Very low.
Yeah, very low. I'm reluctant to believe that investors, hedge funds in particular, are short or very short here, number one. Number two is I've been in the business, for some length of time, and have had conversations over the years with hedge fund proprietors. And it is very rare for me to find guys or investors who are willing to short 52-week lows, stocks at 52-week lows. Most investors want to short stocks that are at 52-week highs. And so I don't believe that investors are very short here. It might be that there is a good short position with respect to the S&P with the spider, the SPY, but as it relates to individual stocks, the data just does not corroborate what is kind of, fairly widely distributed consensus opinion.
Can we explore that idea that people don't like shorting 52-week lows and they prefer to short the highs? And I'm assuming you feel that that's not the right course of action to take.
Yeah, so I'll start with the second part. I don't think it's the right course of action to take, because the stocks that are at 52-week lows are there for fundamental reasons. They're not there for technical reasons, right? The technicals kind of identify it. They identify a poor trend, a stock that looks like it's going to fail. Their indicators help them determine that. But the stocks go where they go for fundamental reasons. And so most people don't want to short 52-week lows because they're afraid of a stock bouncing back. And I understand that's a legitimate fear, because you could get taken out of your position fairly quickly. But I tend to believe that stocks at 52-week lows are there for a reason. And I found when you're in a bear market, stocks go down much further or for longer than is otherwise the case in what is a bull trend. And I think we're in a bear market, and it's not crazy. And we've seen this, a lot already. It's not crazy to see stocks go down, 80% from their peaks when you're in a proper bull market, and when a prior bubble, and I think I can say that we've had a prior bubble. I think when you get a prior bubble that breaks, you can find stocks that go down, 80 to 90%. Now, pick one out just because it's prominent, not because I'm going to castigate it. But ARK, the ARK Innovation ETF run by Cathie Wood, and I'm not saying anything negative about Miss Wood here, I'm just giving the example. ARK, which peaked in February of 2021 at about $160, was down 80% at its lows in mid-May, so to speak. It's gone sideways since. It had a big percentage rally, but is really sideways since. But again, it was down 80%. So I think this is not uncommon in big bear markets, and I think that's what we're in. So I would prefer to short stocks that are making 52-week lows, because I'm of the belief that the trend is likely to continue, and they're there for fundamental reasons, not technical reasons. And in addition, I'll just say this right here. Most stocks that are in big bear trends tend to fail through valuation support levels on multiple occasions. And so I always use a line that was taught to me by the great investor Leon Cooperman, that stocks find support based on valuation or fundamental reasons. But if they haven't yet found those support, then clearly they're not cheap enough.
That's a terrific bit of wisdom from Leon Cooperman. John, why don't we take this opportunity to explain go back to the idea about the growth versus non-growth, and maybe talk a little bit about how this might resemble the 2000 blow off top that we saw there, and kind of how that fits in terms of your framework of explaining why we're in a bear market.
Okay, and I know you guys are going to put up the charts that I sent you. I sent you a chart packet.
Yeah.
And this chart will be in there. It'll be on page 7.
Okay.
So thanks for the question. So here goes. So in March of 2000, this growth to non-growth ratio that the people who will take a look at the video will see on page 7 peaked in March of 2000. The momentum for this ratio got excessively or egregiously oversold in December of 2000, which means that, for all intents and purposes, the great momentum flush had ended in December 2000, so 9 months later. However, despite the fact that the momentum improved for this ratio, which meant that it was not going down as fast, or it was going down slower, the ratio itself went down until June of 2008, which means that from March of 2000 until June of 2008, non-growth outperformed growth. This was despite the fact that momentum had bottomed in December of 2000. So I'm going to try to make it easy on people who will look at this, or another way to think about it. So from March 2000 through December of 2000, growth lost to non-growth by 10 to nothing, a score of 10 to nothing in the growth to non-growth game every single week. However, from December 2000 through June of 2008, growth lost to non-growth not by 10 to nothing, but by 5 to 4, 6 to 3, 9 to 7, 8 to 2, 1 to nothing, 2 to 1 until June of 2008. So despite the fact that it was doing better from December 2000 through June of 2008, it was just losing at a slower rate. And I think that's what is an important takeaway. Now, I'll just update it on page 7 for people who are going to look. The momentum superseded in 2020 the momentum peak that we saw in December of 2000. It superseded it. So the momentum at this point, and this is not a percentage, MACD, it's an arithmetic one, so we'll just stick with this for now. The momentum superseded it. So you have tremendous momentum on the upside, and I would argue that it went at a faster rate than it did into the March 2000 peak. So not only was momentum greater, but it happened at a faster rate. And so momentum peaked, and then it declined into what was mid of 2021, had a big bounce, which never occurred in the 2000 period, and then made another low into the spring of 2022. Oddly enough, Kevin, the spring of 2022 low in momentum for this growth to non-growth ratio was lower than it was in December of 2000. So we actually collapsed with momentum at a lower or worse level than it was in December 2000. And of course, this kind of makes sense for people who will follow charts and momentum over time, is that the pendulum swung to a great degree, its most egregious degree ever on the upside, and the momentum had to crash to its most egregious or lowest level ever on the downside. So the pendulum went from its biggest level on one side to its biggest level on the other side. It erased all of that great momentum that occurred in the last 2 years for growth over non-growth.
And so, do you kind of envision that we're in like a late 2001, early 2002 period where momentum went back to unchanged, yet it just growth just kept leaking versus?
Yeah, I think that's a good way to say it. I think that's a very good way to say it. Now, I don't know that the market's going to be down big from here. I don't know that. But I do kind of have an idea, or I imagine that the market will be difficult in that it'll be kind of sideways, down, choppy, and grind it out for a long stretch of time. And I'm just going to refer back to page 3 in the chart packet that you'll show. I show the Dow Jones Industrial Average from 1910 to date. And I've annotated it with what I think were 5 big up cycles. The big upcycle, the 5th one ended, of course, into 2021. And I think there have been 4 prior big sideways cycles, 1910 through 1924, 1937 through 1950, 66 through 82, and then 1999 through 2012. And those sideways cycles worked with a bunch of volatility, rallies back to the former highs, failures. And so I think we've started this sideways, the 5th sideways cycle. I don't have a great idea as to how long it will last, but they tend to last for longer than you think. The first one lasted for 14 years, the second one for 13 years, the third one for 16 years, and the fourth one for 13 years. So you're certainly into the teen years. I realize that there are not a lot of historical examples, and this would not be admissible in a statistics class, but it's certainly admissible in a portfolio management class.
I like that. Let's go to page 8. You have a quote from another famous investor, and that kind of has a similar viewpoint. Why don't you just read us what Stanley said?
Yeah, so I got lucky in that I've been showing this chart for some months, and then Stan Druckenmiller said this last week. He said, when I look back at the bull market and financial assets since 1982, all the factors that created it not only have stopped, they've reversed. And then he gave a full disclosure. He's had a bearish bias for a long time. But he said, maybe most importantly, when this was going on, we were right on the cusp of globalization that led to a lot of productivity and disinflation. The response after the GFC was zero rates and a lot of money printing, quantitative easing that created an asset bubble in everything. Now, and he means central bankers, especially the Fed, they're like reform smokers. They've gone from printing a bunch of money, like driving a Porsche 200 miles an hour, to not only taking the foot off the gas, but they're slamming the brakes on. And then I highlighted this in bold font. There's a high probability in my mind that the market at best is going to be kind of flat for 10 years, sort of like this 66 to 82 time period. But the nice thing is there were companies that did very, very well in that environment back then. And he's right. And so I hope this doesn't make both of us wrong. But I tend to agree with his statement there, and my chart, which I just kind of went over a little bit, which people will be able to take a look at. They could take a look at it for themselves and get an idea what I'm thinking about.
And so I agree, and I think that a lot of people have kind of taken for granted and think that the stock market always delivers 8 to 20% every year, and when it doesn't, it's crashing. And I remember periods when the stock market was a whole lot more boring. And I'm always kind of shocked when people are surprised when it's not as action filled as we think. Do you suspect that people are going to be also surprised at how boring it gets?
I think people will be surprised as to how, I don't know if it's going to be boring, but how difficult it will be.
Okay.
And I think there's a lot of recency bias. I think for sports fans, there's also a lot of recency bias. The person you see play today is the greatest ever without kind of having a kind of some historical grounding as to maybe there were some great players that played before them that set the records in another era. And so I think this is likely to be difficult, and it might be appropriate, especially because we know where inflation is now. Inflation now is as high as it was during the 1966 through 1982 period. Well, if inflation is as high as it was then, and that was a difficult period, well, then maybe I should kind of get an idea that this period will be difficult. And then I think it's also important to understand that inflation is at 40-year highs. The last time inflation was this high on a PPI basis, it took the Fed 9 years to get the inflation genie back in the bottle. 9 years. And so I don't think that there are many investors out there who would even like to consider that. But in addition, when inflation on a CPI basis first moved above 2%, it took 20 years for inflation to move back below 2%. So
Can I interrupt here with a stat that I grabbed from one of your pieces? It says over 219 months from October 73 to December 91, core CPI year over year was more than 4% for 95% of the time.
Yeah, there you go. That's it right there. Thank you for saying that.
I would have never guessed. All right, let's keep going on your slides here. I got one that I just love to talk about because I am a huge Marty Zweig fan.
Oh, terrific.
Page 10.
Yeah,
I still remember I love going back to his October of '87 appearance on Wall Street.
Oh yeah,
and he's a god. He was terrific. The guy who originally came up with "Don't Fight the Fed." You have a whole bunch of rules here. I'd love to just kind of. Why don't you tell me what the purpose of the slide was? Pick some of the ones that you like. Just speak to it any way you'd like.
Okay, so on August 31st, I had a webinar. And the title of my webinar was "Who Was Marty Zweig?" And I remember Marty Zweig on Lou Rukeyser's Wall Street Week. I actually appeared on that one time as well. That'll give you an idea how old I am. But Marty Zweig, was clearly he had a PhD. Number one. Number two is he did a lot of fundamental macro work, but clearly developed a lot of indicators, and he let out some or gave us some great rules as to how he kind of thought about the market. And he was a fantastic investor. And he also at the time had a newsletter, which I can tell you a funny story about in a second. It's not pejorative, but it is kind of cute or humorous. And so I wanted to use Marty Zweig's rules because I thought that number 6, don't fight the Fed, and number 1, the trend is your friend, don't fight the tape, which is a corollary to Stan Weinstein's another great analyst and a friend of mine. Stan Weinstein says the tape tells all. But I thought Marty's 2 rules, the trend is your friend, don't fight the tape, and don't fight the Fed, were being ignored by most investors. And I said in the side box, it's curious to me that investors who didn't fight the Fed when the Fed was easy are now determined to fight the Fed when the Fed is tightening financial conditions. And I said rhetorically, how long can this market hypocrisy continue? And it's remarkable to me that people do want to fight the Fed. And that goes back to kind of one of my earlier points from your question. And I said, I think the environment has changed. And we're in a bear market. And in a bear market, it's usually the opposite of a bull market. Whatever occurs in a bull market, bad news or good news, stocks go up. And whatever occurs in a bear market, good news or bad news, stocks go down. And I think when you're fighting the Fed in a bear market, that's a recipe for disaster. And when you're not paying attention to the tape in a bear market, that's another recipe for disaster.
That's a very eloquent way of putting it. You got to tell me the story about.
Sure. So my partner at Lehman Brothers was Steve Shobin. I mentioned his name earlier. And when we were at Lehman Brothers, we had kind of this fantasy that the two of us would leave Lehman Brothers together and join another firm because we worked so well together. So I had the kind of bright idea. I said to him one day, and I called Steve Shobin Shobes. I said, Shobes, why don't you call Marty Zweig and see if he has any suggestions for us. And so Steve said, yeah, that's a good idea. I'll give him a call. So he calls and leaves a message for Marty Zweig, and I guess Marty may have been traveling for business or away. And it took maybe 2 weeks for Marty to call Steve back. And so Steve picks up the phone and he's speaking to Marty. And Steve and I shared an office at this time on the trading floor at Lehman when we were in the World Financial Center. And he's talking to Marty, and I was really excited about Steve getting off the phone so I could ask him what kind of great Socratic advice Marty offered us. And Steve gets off the phone, and I said, Shobes, what did he say about our idea? And he said he didn't have anything to say. He thought we were calling him because we wanted to buy his newsletter business. So, both of us got a good laugh out of that. And, the best laid plans of mice and men, went for naught. And so we had to keep searching.
All right, let's move on to page 13, because we've been talking a little bit about inflation. I'd love to get your thoughts about what you see in terms of what's in store for bonds.
Okay, so this is a picture of the 10-year Treasury yield going back on a monthly basis to 1970. I've put in the chart a little legend just to show what each of the cycles wrought. And on or around the dates highlighted by 1 through 14, because we're in 15 now, there was a notable financial calamity. And when I was at Soros, I spent a lot of time with Robert Soros, and Robert Soros was always a gentleman to me, and a very sharp, technical guy in his own right. And we would talk about currencies, commodities, equities, sectors, indexes, and of course, bonds. And Robert Soros one day said to me, John, the bond market never lies. And I never forgot what he said. I thought it was just curt, to the point, and very clipped. And it had a lot of, magic in his phrase. There was a lot of philosophy in there. There was just no beating around the bush. The bond market never lies. And I've never forgotten that. And I've been showing this chart now for many months, and just repeating Robert Soros's great line: the bond market never lies. Bond market never lies. Pardon me. And waiting for kind of a big break in 15. We've gotten a big break, of course, with bonds, but individual equities have broken. But the market has been, I think, fairly resilient. I know it's down a lot, but fairly resilient in the face of much higher Treasury yields. And then Dennis DeBuscher, who I mentioned his name earlier, had a webinar here in which Stan Druckenmiller was his guest. And I think Dennis should get the Emmy for asking this question and getting Stan to provide the answer. Dennis asked at the time in June, early June, what is something that consensus has wrong or mispriced? And Stan said at the time that he thought there was too much comfort that there would be no financial calamity. And I think that fits very nicely with the chart, the legend, and Robert's great line.
Well, I'll turn the tables on you. What do you think is currently where the consensus is wrong?
Okay, thanks. I think that's a good question. Number one is that inflation will come down rather quickly. I think the consensus has that wrong. The consensus has been wrong on inflation the entire way. In fact, in the spring of 2021, I created a transitory indicator poking fun at the Fed because I thought it wasn't going to be transitory. It was very easy to do. All you had to do was count the number of months inflation had been above 4%. And I went back historically, and I had an open invitation to Jay Powell or any member of the Fed to join me at the corner of 4th Avenue and 3rd Street in Mount Vernon, New York, so they could explain to the good people there why paying higher prices for their groceries was in their best interests. Nobody's taken me up on that offer yet. So I think inflation is likely to be stickier than most believe. And I think even if the Fed has some success at fighting inflation, I think interest rates are going to remain higher than most believe. I think that's where the consensus is wrong on both of those items.
From there, do you get to back to your idea that growth is going to underperform versus non-growth? Is it centered on that idea about?
I think it is part of the same kind of game plan. It's right in there, on the same punch list, that if inflation and or rates are going to be higher and stickier than most believe, then I think that's another, kind of I don't want to use nail in the coffin. That's too hyperbolic. But I think it's kind of another chink in the armor of growth stocks.
Now, I would love, you have a whole section in here where you go through the socks, the fang mats, all those things, starting on page 18. Could you just whip us through like you're presenting to a bunch of institutional hedge fund managers and walk us through these charts one by one?
Sure. So on page 18, it's a daily version of the Philadelphia Semiconductor Index SOX with its 200-day moving average. And I would just say, without these aren't terrific technical charts because there are not a lot of indicators here. They're not very complicated. They're fairly simple. And I would just say, if you are an absolute fund manager and the only thing you had was that chart at the top, and the item you owned was below a downward sloping 200-day moving average, and you knew that the last two times that it was in a similar position, it had bad performance or weak performance for almost 300 days, and let's call it almost 250 days. And so far, this one's been, and I've been publishing this for months now, for 110 days, 120 days, and now we're up to 165 days. Would you be a seller or would you be lightening your positions? And if you manage money with a benchmark and you want to look at the SOX or semis, the semi index relative to the S&P 500, and all you had was that chart at the bottom panel, which shows the SOX relative to the S&P with its own moving average. I shortened this one to 126 days on a relative basis. Would you be a buyer of these stocks, or would you think that it's probably prudent to reduce your positions? And that's essentially the way I say it. And then, of course, I could bring in something that might show some momentum indicators or a momentum indicator. You could take a look at page 19, which has a similar chart on a weekly basis going back to 1998. And then I put in what was the median historical bear market for the SOX, which got it to 2440. So that was my original downside target for the semiconductor index. And then my thesis, Kevin, during this whole bear market has been that most items, equity indexes and or equities, would at least get back to their pre-COVID high or post-COVID breakout level. And for the SOX, that equates to the 2000 level.
Okay. So we still got some ways down there.
I think so. And then if you turn to page 20, you'll see the historic bear market declines in the table to the right, which goes back to 1995, just so people can get some perspective.
And then the next page, page 21, it's in The Godfather, part 3.
Yeah, so I sent out a note entitled, thanks. I sent a note out entitled Godfather Part 3, and I showed these tables, especially the one at the bottom, I think is the most important because it shows that as of now, and I updated this last week, semis as a percent of the NASDAQ 100, their market cap weighting is now less than 8%, which is, of course, the lowest it's been at least before 2018. And then the top panel, the top table shows just how strong the performance for the SOX was over the 3 years prior to 2022. 2019, it was up 60%, then up 51%, then up 41%. My goodness, there was not a period like this after the GFC. This is the 3 strongest years into its, apogee or its peak, its apocalyptic peak. And it outperformed, its 3-year performance for those years were 104%, 123%, and 242%. I mean, this acted like it was on steroids, or at least running as fast as Usain Bolt. And then its outperformance relative to the S&P and NASDAQ, that's all the way to the right. And then in the year ending 2021, the SOX had outperformed the S&P, over 3 years by more than 150%. It's truly incredible how great the performance was for semiconductors over those last 3 years. And even if you go back to 2014, it almost increased every year. It was only down 1 year, year on year, whereas 51.5% versus 52.5%. Other than that, it accelerated into its peak. That, I think, was quite extraordinary in this environment. Not only did it accelerate into its peak, but that 151.5% was almost double the 3-year performance of the year before. truly tremendous numbers.
And you'd think that would be the absolute best performing stocks, but then the next slide, page 22, you have the big seven.
Yeah,
And
so this has NVIDIA in it, which is one of the semis, but I put this together because I wanted to show what these stocks look like as an index. And you can see that the momentum there was a momentum peak in the middle panel in 2020. And then in 2021, at the end, you kind of corroborated or emphasized that peak. You made a minor new high there. But right after that, momentum started to come out at a tremendous rate. And the absolute chart at the top shows lower highs, and clearly it looks like it's trending down now. It's below a downward sloping 40-week moving average. I convert the dailies to the weeklies, and I use 40-week instead of 200-day. And then in the bottom panel, Kevin, if all you had was that chart in the bottom panel, which shows the big seven relative to the S&P 500, would you think that you would want to be, increasing your weightings here, or would you want to be reducing your weightings? And
no,
I think
it's a big sell. There's it looks like
I think
keeps hitting support. So I'm sorry to interrupt. It keeps hitting support, and we know that something that keeps hitting support often breaks.
Yeah, correct. You did as good a job as I could have. Thank you for that.
And for those who don't know what the big seven is, it's Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. Okay, why don't you walk us through just a few charts here that you've included in this package? Let's start with Google on page 23.
So you can see Google is shown in the same fashion as I showed the big seven. It's a weekly chart in the top panel with a 40-week moving average. It's weekly momentum in the middle panel, and then at the bottom, it's a relative look versus the S&P 500. And I thought that Google would have risk to about 80. My first target was 120, and now it had become resistance. And I think, the pattern suggests that there's lower levels ahead for Google. And 80 is the approximate level of what was the pre-COVID peak, post-COVID breakout level. And I think it's topping versus the S&P 500 in the bottom panel. So it's not that different from the big seven. Of course, Google's in it or Alphabet is in it. So there's a little bit of redundancy. But the chart itself is quite worrisome and evokes, kind of lower levels ahead.
I'm leafing ahead, and I can't help but take you to page 36. Gold. Okay. Let's talk some gold.
Okay.
I'd love to hear how, I think you've explained very well what you feel is going to happen to bonds and stocks and all that. But how does gold fit into your narrative?
Okay, so I'm going to throw myself on the mercy of your court. And here's why. And because earlier this year, I really thought gold had the potential to make an important move to a new all-time high. And I was wrong on that. And then I discovered when it broke that dashed upward sloping trend line and got below its 40-week moving average, and that turned lower, that gold was was likely to actually make an important move lower. Now, gold is an interesting asset, of course, because it's supposed to do better than other assets. It's supposed to give us diversification, and it hasn't done that, number one. Number two is gold is, if not always, often the first commodity over the wall when you have a commodity rally. And gold did that. In 2019, it got above 1,400, and I was lucky enough to think that gold would move to a new all-time high at that point, and it did. And then it kind of sleepwalked from its peak in 2020 until what was late 2021 and then early 2022 when it got a little bit of a push. But it was really kind of a disappointment and clearly a mistake, and I was wrong again on it, to think that it was going to make a new all-time high and power higher and that the commodity advance was going to continue. But gold has historically done better when the dollar has been weak, and the dollar has been a king this year, and perhaps that's part of the reason why gold has suffered.
Right. And so let's go to page 37 because that is the U.S. dollar. Why don't you tell us what you're thinking there, and then maybe how that might relate back to gold?
Okay. So when gold was getting close to breaking above the 100 level, you could see that that's that very long horizontal line, and it's highlighted with the green arrow there at 100.94. I thought that a breakout there would imply that gold could get to, the dollar could get to 120. which really isn't a tremendous call. That really was just the high. You could see it there going back to the early 2000s. I thought it could just get back to the highs. I didn't think it was a heroic call, and I wasn't really, you know, I didn't have to have great imagination to think that. And the dollar has continued to remain strong. It has good momentum in the middle panel. The momentum is clearly not as extended as it was in the early 2000s, and certainly not as extended as it was in the mid 80s. And then the bottom panel shows the dollar on a 12-month rate of change basis. And I've highlighted it with 1981, 85, 93, 2000, 09, and 2015. And the dollar A has rarely been stronger on a year-over-year basis than it is now, except for the early and mid 80s. And number two is usually when the dollar is this strong, it usually is coincident with or is followed by some difficulty in some other asset class. It could be bonds, it could be emerging markets, it could be equities broadly. So I thought that this was another kind of cautionary note by noticing how strong the dollar was and what it has occurred for it when it has been similarly strong historically, going back at least to the early 80s.
Let's go to the next slide, 38, because I like it. You got a target for the U.S. Or for the euro of 85 cents. Not a lot of people are tossing around that kind of number. I like the boldness of the call.
Well, thanks. A bold call can certainly be as wrong as a meek one. So I know that can happen, and I don't think spot 85 is a crazy number, because the former range was 1.25 to 1.05. The difference being 20 cents or 20 euro cents thereabouts. And you just subtract 20 euro cents from 1.05, gets you to spot 85. So it's not, there's certainly no higher math here. And I give you the little remedial formula just to show you how I got to that number. I don't think it's a heroic call. And I think if rates are going to stay higher than most people believe here in the States, then it wouldn't surprise me to see the euro get to spot 85. I might think that they have an inordinate amount of problems with respect to the European energy crisis. So to see this get down there might be a follow-on effect.
We're getting kind of nearer to the end here, and I want to hit a couple before we finish up here. And I'd love to jump back to the stock market, because there's a table or a chart on page 44 that really interests me. It's titled "Choke Up." Why don't you tell us what that is and what it's signifying?
Okay, so I had another webinar some time ago that I entitled "Choke Up," and I had a picture of a former professional baseball player whose name was Matty Alou, Alou, and he was one of three Alou brothers, Jesus and Felipe, to play in the major leagues at the same time. And Matty Alou was a terrific hitter, but he was probably what is known as a slap hitter, and he choked up, to an important degree on his bat, and he was trying to put the bat on the ball, and probably using Wee Willie Keeler's famous line, "Hit him where they ain't," and kind of use his speed. But I thought that he had greater bat control because he did choke up. And, for those of us who have played baseball, or who play baseball now, or their kids do, when they're facing a tough pitcher, or perhaps when they have two strikes on them, it's usually a good idea to choke up. You have a little bit more bat control. And I thought the analogy would be that portfolio managers should choke up and not be as aggressive with their portfolio weightings, given the way the market had behaved and continued to behave. I think if you're going to be involved here, it's probably right to be involved with smaller positions relative to bigger positions, because I think if you then make a mistake, it doesn't hurt you as much. And so that was kind of the idea about choke up.
Got it. All right, let's go to the questions that I love to ask all of our guests at the end of the interview. We'll start with your favorite investment book.
Okay, I'm a big fan of a book written by Sebastian Mallaby entitled "More Money Than God." Hedge Funds and the Making of a New Elite. And the book was released in 2010, and I know it's kind of a a crazy topic to think that somebody might have more money than God. But that really wasn't what interested me about the book. What interested me about the book was that we got to hear from um, terrific, legendary hedge fund managers who each shared with us, the reader, kind of their little, inside baseball as to how they did their job or how they thought about their job. And what it's selfish of me to say, what was especially gratifying to learn was how many of them employed technical analysis in some manner of their job. And I think for people who have an affinity for technical analysis, it's a good read. For people who don't have an affinity for technical analysis, it's an equally good read. But that's why I thought it was really important for me. It showed me that these guys, each of them did their job differently than the other, but they all had great success. And I'm fond of this analogy. There are loads of grass eaters on the Serengeti plains, but they all survive because they all eat a different part of the grass. And I think that's kind of, emblematic of our business. There's a lot of people who do very well in our business, but they all do it a little bit differently.
That's a great analogy. I've never heard that. All right.
Thanks.
So we talk about those terrific traders that are interviewed in that book. Do you think those traders are born or made?
I think they're made.
Oh,
I think they're made. Yeah, I really do. I think they're made, and they're made primarily by their mistakes. We learn more from our mistakes than we do our successes. I think they're made because they probably have had some success and their imagination has grown and they become kind of, more focused. I think they're made because many of the people in the book, as if anybody decides to read it, these people who have had great success, many of them had great mentors. And so, they were taught as, some of the rules of the business. And of course, they were able to use those lessons to great success, which kind of brings me to a second book. Can I mention a second book?
Yeah, sure. Go ahead.
Okay, so my second favorite book that I think is appropriate for our business is not an investment book at all. It's a book entitled Shut Up and Deal, written by a guy named Jesse May. And Jesse May was a poker player in and around New York City before Texas Hold'em became popular. And let's say, Kevin, he came to your apartment tonight and the game started at 9:00 and maybe it played till 2 a.m. And maybe Jesse May left a few $100s richer. And maybe he came to my apartment on Wednesday night and the game started at 9:00 and he left at 3 a.m. and maybe he left also a few $100s richer. And there's a great line in the book that Jesse May tells the reader, which was also repeated in the book entitled Positively 4th Street, which was a book famously popular some years ago, which was a song by Bob Dylan. But it was a book about a guy who went out to the World Series of Poker for Harper's Bazaar, ostensibly to cover a murder trial, but he took his advance and played his way into the World Series of Poker. So he repeated, yeah, it's a great read. And so Jesse May's line, which was used in Positively 4th Street, the book, is as follows. And I'm going to cuff it a little bit, but this is the spirit of it. Jesse May said, when people start playing poker, they want to master the rules. He said, but being successful at poker is not mastering the rules. Being successful at poker is mastering the luck.
Oh.
And I think that's appropriate for our business as well. It kind of is when you say, something is overvalued, but the trend is going to supersede the overvaluation. It's going to get even more overvalued. That's the luck. Or when something is in a downtrend and people might think it is cheap or undervalued, but the downtrend overwhelms the supposed cheap valuation at that point. I think that's kind of mastering the luck. And the only way you do that is by failing. You kind of have to learn the luck when it's appropriate to kind of use that to go against the grain or against the rules. So I really like that line.
John, I've asked a lot of people that question. That's going to go in the top 5 for sure. Maybe even top 3, even top 1. That was a terrific answer. That really was. Okay, thanks. Let's talk about Byron Wien. Byron Wien loved to publish his market surprises. And what his market surprises were something that he thought the market assigned a less than a third chance of occurring over the next year, but where he thought it had a greater than 50-50 chance of happening. Do you have a Byron Wien surprise for the next year for us?
Oh, I think it might be that what I mentioned earlier, that rates will likely be higher than most people believe. And I'm going to say it now, and I'll say it softly, but I'm going to use, again, still another analogy. Do you know when you've seen a movie about 100 times, and then you see it the 101st time, and you say to yourself, my goodness, I never noticed that before.
Yeah.
Yeah,
Yep.
so I did that today with a chart, a long-term chart for the 12-month Treasury yield, and I noticed that um, the former range for the 1-year Treasury yield, a 1-year T-bill yield, from late 50s through 2008 produced an average of about 6.3%. It was only when the Fed dropped rates to zero, of course, that this rate broke what was the former low going back to the early 60s. And I thought to myself, if this is a reversion to the mean business, is it really crazy to expect that the 1-year Treasury bill can work back to 6% when the average yield for this 1-year Treasury from 1959 through 2008 was 6.3%? So I think this would be a Byron Wien surprise that you actually get the 12-month Treasury bill yield to get near or to 6%. I don't think that is well discounted, and I would almost guess that it would Byron might assign an even lower probability than 1/3.
I would agree there. All right, that's a great answer. Maybe we can get another great answer with the Don Cox. I don't know if you're familiar with him. He was a Canadian strategist.
Yes, I do remember Don.
Oh yeah, he used to talk about you shouldn't invest you shouldn't invest in what's on page 1 today. You should invest in what's on page 19 on the way to page 1 tomorrow. Do you have a Don Cox investment or idea for us?
I'm going to say I don't, but not because I don't want to answer your question. I think it's especially difficult. I think Don, has given us a good game plan as to how to think about it, because at least you don't want to be investing in what's on page 1.
Okay.
But I think it's very difficult because to find what would likely be that page 16 to page 1 going forward, because I don't think any of us really know. And I'd like to say that, I heard this today. This is not my line, but it was said to me earlier from a longtime contact. I don't know if it's his. He could have gotten it from somebody else, but the line was, in the late 90s, nobody knew that Amazon was going to be Amazon and that Pets.com was going to be out of business.
Oh, that's true. Yeah.
Nobody knew that. Again, it's not my line, and it may not even be my friend's line. But it was only after some time, of course, then Pets.com went out of business, and then Jeff Bezos, directed Amazon to great heights, portfolio-wise, and for his ownership stake. So I think that's a very difficult one. I'm going to leave that to
no, that's a great answer anyways. It's a terrific answer.
Thanks.
All right. And then my final question to you is, if you were to chat with somebody that's getting a young person that's interested in this business, what advice would you give him or her?
Okay. My polite suggestion would be, after you're done reading all the books you can about our business, stop reading them and read other books. Read history books, especially. Read sports history books. Read anything you can get your hands on, because you can't describe the market by describing the market. You can only describe the market and make it make sense by creating analogies or metaphors using other examples. That's the only way to describe it. You can only make it make sense to others by not using the market to describe itself, but by using other historical examples, history, sports, movies, music, sitcoms, whatever it is. That's the only way to do it. You can do it that way to great effect.
That's a really super interesting answer. All right, John, this is the time when I let people learn a little bit more about your firm. You've talked about your firm. Why don't you talk about specifically what you offer, how people that are interested in learning more about getting your services or contacting you or following your work might reach out to you?
Okay, so we're 22V Research. And you can certainly check our website, and that's 22vresearch.com. We are an institutional firm,
Yep.
and Colin Crowley heads up our sales effort here. But certainly somebody could take a look at the website and see what some of the offerings look like in terms of research product. But if anybody has any interest, certainly contact Colin Crowley, and he's a gentleman, and he'll certainly speak to anybody who's interested with respect to either RIA accounts, family offices, hedge funds, and or long only institutional accounts.
So right now, unfortunately, anyone retail cannot get your product.
It's not a retail product,
right,
unfortunately.
Yeah, no problem. We appreciate you taking time and sharing your views with the retail audience. So it's terrific that way. If you are an institution and do you want to learn more about it, reach out to 22V, as John said. You're not on Twitter. You've managed to avoid that morass.
No, I am on Twitter. It's at the DA Chart Life.
There you go.
And aside from kind of talking about the market or market related items, I'm certain people might get a little bit sick of me either reposting or posting some sports stuff.
Listen, if that's the worst you do on Twitter, John, is not that bad. All right. Before I leave you, I always like to chat about something maybe a little bit personal. And I noticed in a lot of your research pieces, you talk about music. And you're roughly the same age. You might be a little bit older than me, but you mentioned Talk and in a recent report. And I was just wondering, you grew up in New York City. You were probably the right age to see some new wave bands and stuff. But did you ever happen upon any great concerts or any insights that you share from your younger youth?
Yeah, so I saw Squeeze in concert.
Oh, that's a good one.
Yeah, I saw Billy Idol in concert. I saw the Ramones.
Oh, wow! Where did you see the Ramones?
I saw them at Fordham University, right in the gym.
Oh, they came and played your gym.
Yeah, so did Billy Idol.
Oh, Billy Idol came to your gym?
Yeah. Romeo Void came. 10,000 Maniacs came. Whoever got the bands at that time did a great job.
That's a terrific story. I thought you were going to tell me what's the bar in New York City that the Ramones played all the time?
CBGB's?
Yeah, I thought you were going to tell me you had hiked into the city to watch them there.
No, I got to see them at Fordham. It was really good. I saw Squeeze at Madison Square Garden, but the others I saw at Fordham. I got really lucky. I also saw the B-52s, but that was at Jones Beach many years later. And I know this might not count, but at 5:45 a.m. one morning, walking through Rockefeller Center, I saw the Go-Go's preparing for their Today Show appearance. So I got to see I got to have a really intimate, up close concert with the Go-Go's. I thought that was really as just about as cool a New York experience as I could have.
Yeah, well, you've hit my soft spot. I'm actually a huge Belinda Carlisle fan, and so I am a little bit jealous of that. Anyways, John, it's been a real pleasure getting to know you, and thank you so much for your time. This was a terrific interview, and I really appreciate you spending this time with us.
My pleasure, Kevin. Thanks for having me, and thanks to Lena, who had great patience, and you did as well while we got this all hooked up. So it's my pleasure. Great to speak with you, and thank you for having me on. I'm really appreciative of you showing some interest. Thank you very much.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. Lena gets tired of talking to Patrick and myself. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all the latest charts and visuals. And while you're there, please like and subscribe to get our latest content. For Patrick, he's not here, but you can check him out on Twitter at Patrick Ceresna, or check out his service at bigpicturetrading.com. And myself, you can find me on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Thanks for tuning in. Don't forget, next week is a week off, and we'll see you on October 7th.